30 hours every week, and you still don't know. EA drops and the market moves fast. You read it last week's data, how long does that last? Crude and Nat Gas telling you a story. Visibility, velocity, that's the glory. One signal every morning before your coffee's cold. Green means go, red means hold. This is rogue radar, signal every day. Oil and natural gas cleared out of your way. 5 minutes of clarity, that's all you need. Get the rogue method free, then let rogue radar read the market. EnergyRogue.com.
Hello, folks. Bill and Brian here with the weekly update. And let me tell you something, Brian. We're going to talk about one of my pet peeves this week. I'm really excited about this. I tell you what, I have family that lives out in California. Now, where I live, we call it Interstate 40.
Okay.
Where they live, they call it the 40. Or it's not Interstate 10, it's the 10.
Or it's kind
it's
of like
the
college
101.
football when they talk about the Ohio State University, when they
Yes,
talk about
exactly.
the Texas A&M University, right?
It's like it's a living organism. Now,
Mhm.
I do understand that when you get into traffic on some of those highways out in California, it feels like it's a living organism trying to swallow you. I get
Right.
that.
Yeah.
But that's the reason the pet peeve is today we're going to talk about the market. Anytime you hear an analyst, they'll say, well, the market says, or the market's saying, or the market, and it's like there's a entity out there called the market. I guess this would be compared to the Borg.
Right.
And so,
Yeah.
and so when we
I
talk
like
about
that
the
reference.
market,
I like that
yeah,
reference, by the way. Well done.
and when we talk about the market, we want you to understand what we are talking about. And it's not an entity that's out there.
Mhm.
And we're going to talk more about that but what you're going to see here is when we talk about the market, don't look like there's some conspiracy theory out there, somebody who's controlling it with this giant switch that moves it up and down. That's not what it is. What you're going to find out is that you are the market.
Yeah. Well, and that's what we're going to talk about. So a lot of people in the energy industry and or ancillary industry that is trying to understand energy prices or energy movements in value on oil, natural gas, diesel, propane. We're just picking on those four right now. There's multiple products. We cover them all here at Energy Rogue. But understanding all those when we talk about the market. And for reference, Bill and I have been in the energy industry for a long, long time. We've been at multiple companies, some huge multinational companies and some small companies. And a vernacular that we run into a lot is people talking about the market says blank. The market says it's bullish. The market says it's bearish. And we here at Energy Rogue, we try and take a layer a little bit deeper. So what we take a look at is we segment things into the two areas, and it is the biggest mistake that a lot of commodity traders fall into, and that is they only listen to the financial market or they only listen to the physical market. And it's really a combination of the two, and understanding that the price sometimes is driven by financial markets and the price sometimes is driven by physical markets. And what do we mean? In the financial market, that could be futures, options, ETFs, speculators, hedge funds, algorithms, stock market. There can be index valuations, there's currency valuations that come into energy prices.
And there's weather and there's geopolitical things and there's all sorts of things in the financial markets.
Yep. And then you have the physical market. This is where the physical supply and demand, producers, refiners, LNG exporters, utilities, pipelines, end users. I'm not going to do the whole story right now today, but for those that only followed the financial market may have found it curious that right after COVID, the crude oil price went negative. And the reason why it went negative is because of a futures dynamic that required a physical delivery of a product. There were only 3 people that could solve that. 2 of them did not want to do it. And the one really didn't want to do it until it reached minus $40. So the thing is that the physical market is where rubber meets the road. The question is, financial market, to use a quote, was it Buffett that said that on illogical? Then you could stay.
Oh, yes, that's right. The market can stay illogical longer than you can stay liquid.
The market, there it is again. The market. So the financial market.
Let me give you. I'll give you a quick story on this. When I was on the trade floor, I was working with a certain desk, and they were wanting me to buy some physical gas.
Mhm.
I went out and got a price, and the price, I said, I came back with this price, and my trader says, well, that's 2 cents out of the market. We're not going to pay up for that. And so he thought about it, and he came back and says, well, I'll tell you what, why don't we go ahead and get that? I said, it's gone.
Yeah.
He says, gone. I says, yeah. And I says, well, here's the deal. Just because your screen says it's 2 cents out of the market, he sold at that price. So guess what? That's the market.
Yep.
It's not
That's
what he's offering, it's what a trade is actually being conducted for. And so when
right.
trade executed at that price, now that is the market.
Yeah.
He thought about it, and he did, much to his chagrin, he did have to agree with me. That's how that goes. And so that is the difference between physical and financial. You have a physical market to where it's trading actual, you're going to take delivery. The
Right.
financial market, you actually do everything you can from taking delivery.
Yeah. And that's that's where a lot of people get stuck, is they look at 2 different worlds. The financial market, what do the traders think will happen? And sometimes that's driving things. Sometimes that's driving valuations. And sometimes the physical market is looking at the financial market saying that's crazy. The physical market, they trade real barrels. And I'll give you a perfect example.
Right.
We're recording this in June of 2026. The financial market says that WTI is worth $91 and that Brent is worth $94. However, in the physical market, that $94 Brent price that is existing on a ship right here is actually trading for 120 to 150. So the financial and physical market are not in alignment. Now, does that mean the financial market's going to come up to 120, 150, or the physical market's going to go down? That's the puzzle. Then that's what we dive into.
And usually the answer to
day.
that question is yes. It's going to do both.
I would say on a long-term basis, the physical market is going to drive, but on a short-term basis, the financial market is going to drive. But why does the financial market dictate the headlines and the short term? On a single day in June, 252,000 contracts were traded on crude oil. Each contract is worth 1,000 barrels. So that meant on that day, 252 million barrels were traded for. One buyer, one seller. So you could call it 500 million, because you had 250 million people buy and 250 million people sell on the volume. But what is the physical production? 105. Well, wait a second. How can we trade more than what is in the physical? It's because this is the scale, and this is what futures trading, anybody that has financial capability can trade that. It's part of the reason that when you have stocks or when you have bonds or options, you can have trade misalignments that don't actually represent reality. The difference is the financial volume on that particular day was 2.4 times the physical reality. And this is the iceberg analogy. So you got the visible tip. That's the futures market, what everybody watches, what everybody dominates the headlines, what traders are reacting to every single day. But the massive structure underneath is the physical market. That's the real supply, real demand, real storage, real flows that ultimately will determine where prices will go. So most market participants only stare at the tip. Professionals are understanding the complete structure of the iceberg, and the physical fundamentals, they will force financial prices back into reality. Now, how long? That gets back to Buffett's comment,
Right.
because
Exactly.
it can last a long time, right, Bill?
I tell you what, it can last longer than you want it to. So a good example is when crude oil went negative, it did not go negative in the field.
Right.
People weren't paying people to give away their crude oil.
Yep.
Some of their prices were based on that. But the bottom line is that if it was negative, then they would just stop producing.
Right. Yeah. And that's it,
And
and that's the physical reconciling to the financial traded market.
right,
And that's
exactly.
where there's a tug of war. Sometimes financial is driving the bus, sometimes physical is, and it goes back and forth. So,
And you will find somebody who argues from both sides of that. Some will
yes,
be saying it's the financial that's driving it. Some will say it's the fundamental physicals that's driving it. But the reality is what's driving it is demand. And
yeah,
there's demand on both sides.
yeah. Well, and that's part of the reason. So, for those that don't know us, this is Brian and Bill with Energy Brogue. We follow energy markets, and we actually structured a software as a service and newsletter service that provides narrative and data analytics, as well as a software that allows you to see the market so that you can understand technicals, fundamentals, the supply, the demand, every facet that is driving the price, because one of these variables is driving the bus every single day. And we look at this every single day. This gets generated every single day with a market narrative, with
Right.
what is happening in the pricing of the market, the physical side and the financial side. There's more information down below. There's also a free ebook if you're trying to understand the energy markets and you get overwhelmed. This is going to give you that. So who
So
trades?
so
Hmm,
let's talk about it here, Brian. So let's talk about why each one of these markets exists. The physical market exists because we actually need a real product. And
mm-hmm,
so that happens. But in order to provide certainty to go out and make the commitment it takes to drill and to do all this stuff with crude with to produce crude oil and natural gas, they need price certainty. So the financial market was created, by the way, it was created after the physical market was going. The
right,
financial market was created to provide certainty on future prices for these because we no longer had long-term contracts. When
right,
the long-term contracts go away, you have to provide some sort of certainty for price. And that in the physical world, that's called hedging. And they're hedging their prices going forward. But so that's the difference between hedging in the financial world is called trading. And
right.
that's why they're getting in and out of the positions on a regular basis. And you have to be careful to understand what your position is if you're in a physical market. You want to be hedging and you don't want to get into the trading business unless you're willing to take the risk that comes with it.
Yep, yep. Well, and um, in looking at the players for financial and physical markets, let's look at them. You got speculators and investors. Speculators are hedge funds, commodity trading advisors, high frequency traders, proprietary trading firms, retail traders. Investors are pension funds, commodity ETFs, index funds, asset managers. Um, Meanwhile, who trades physical markets? Three main criteria: producers, consumers, and midstream. And usually you will have a blended trading company that is some portion of the value chain, either producer side, a consumer side, or midstream side. But they
Right.
have an anchor there. So the financial market, they vote bullish, prices will rise. bearish, prices will fall, or neutral. For instance, one commentary on a trade floor one time, there was a bearish report that came out on natural gas, but natural gas price went up. And our CEO at the trading firm came up and asked me, why did prices go up if we had a bearish report? Somebody with a lot of money, the financial market, wanted it to go that way. And he said, why? And I said, that's what you got to figure out. That's the puzzle. Is it because they were behind and they expected it more bearish and they're worried about covering their position and they traded against it and expected it to be really catastrophically bearish and they're catching up? Or was that an indicator of something bullish down the road, that this was a cue that it could have been the starting point? So are they exiting a position or entering a position? So that's the puzzle with the financial side. Now,
Well, Brian, you always leave out my conspiracy theory on this
okay.
because it's the burnt toast theory.
Yes.
And that's where one of these rich guys, that morning, someone came in for breakfast. They burn his toast. He comes in a bad mood and he says, I'm tired of this old business. I'm getting out. And he sells everything and it changes the market, all because somebody burned his toast.
Yeah.
So that's sort of the Bill Shanahan way of saying, you never know exactly what causes it, but there's somebody who has made a decision to go one way or the other.
Yeah, definitely. So what the physical market weighs is storage, refineries, production, demand. They look at those metrics every single day. They look at the key drivers being production, OPEC plus, what's happening. For instance, we're recording this in June of 2026. OPEC and Strait of Hormuz is full front and center because it's impacting production or supply. Global demand, that's going to be driven on economic growth, refinery utilization on the crude oil side, exports, storage, all of those. Let's take a look at an example. For instance, if the world demand, this is an if, not a statement, world demand is, say, 105 million barrels a day, but we only have 103. That's a 2 million barrel a day deficit. The market's short. So what happens next? Storage begins drawing or taking out. Inventories decline as demand exceeds supply. Prices will eventually rise, not because traders want high prices, but because the physical barrels are starting to disappear. There's a scarcity. So that's a physical manifestation of the cycle. Now, what happens is, in that example before, that bearish indicator may have actually tipped somebody off to the demand side or the supply side that is out of balance. And they may have had a forecast that the prices will eventually rise because demand would outstrip supply. Now, natural gas is a little bit different. Oil is global. Natural gas is regional, although it is catching up with LNG, but just not quite to the scale yet. Pipelines matter, weather matters, storage matters. For instance, I mentioned Energy Rogue. Let's take a look at it right now. So natural gas in the United States is $3.13. We're recording this on June 8th, 2026.
And that's at Henry Hub.
At Henry Hub, that is in the United States. And then you look at two other pricing points, TTF and JKM. So in the US, it is $3.14, but in Europe, which is the TTF pricing point, you're over $16. And in Asia, you're over 18, you're almost $19. So that is the difference between where the market is. Pipelines matter, weather matters, storage matters, location matters. And that's why natural gas is more regionally contained. But what are the key drivers? Production, LNG, weather, power burn, industrial, and storage. So those are the key factors on natural gas. Now, natural gas example, storage capacity is approximately 4.3. Expected end of season right now is 4.1. I don't think we're going to get there, by the way. I think it's going to be 3.9. So in a bearish scenario,
Wait. You said that last year.
and let's see where we got. Let's see where we got. I'm going to let this load up. So we'll let that load up. And for those that really want to dive into it, let me go to storage right here, and we got to the top point, 3.95.
There we go.
So if I said that last year, I was pretty close to the mark.
Yeah, you were.
I
I
think
was
we're
at
gonna.
3.7. I lost out. You went to 3.9 pretty early.
However, I think I started a lot lower than that. I crept up.
Well, we both
to
started
3.
a lot lower. Yeah.
Yeah,
Yeah.
I think I crept up to 3.9. So,
The
but
winter didn't develop last year.
in a bearish scenario, 4.1. In a bullish scenario, 3.4. And what Bill and I were just talking about is what we share in our videos, in our narrative that you get every single day. And in this narrative is an expectation of where we're going to go. We always take a look at 3 angles: where we came from, where we are, and where we're going for each commodity. So technicals will fail more often. There's more volatility in natural gas, mainly
Right.
because of heat waves, hurricanes, pipeline failures, polar vortexes, LNG, storage. All of these, the chart reacts very headline driven. Now, propane and propane accessories, propane. Sorry,
That's right.
had to
Hank
had
Hill.
to had to fit in some Hank Hill. Heating fuel oil, petrochemicals, exports. Those are the 3 key anchors for propane demand. And we were just looking at this the other day. If we look at propane stocks right now, it's got to load up. There it is. We can see that this is a range of the 5-year averages of where we are. We are significantly above that, which is unique for
Right.
the United States because propane globally is short. So, but propane is becoming global. Historically, propane was primarily domestic heating, but we noticed and start tracking propane exports right here. And propane exports have increased 10% year over year. So the propane out of the United States, and let's look at that relative to net production. So look at this. Almost 3 million barrels a day, 1.6 of it is exported. That's a pretty significant share, right?
Yep.
So propane is a global commodity. It can be transported very similarly to oil or
LNG.
even or diesel. Um, Diesel market, trucks, rail, mining, agriculture, construction, marine industry. All of these are kind of the economic health. As a matter of fact, I often look at diesel markets as kind of an indicator on where the industrial commodity market is going. If the industrial market is strong, that means that there's consumer demand or demand in the industrial side. That means that the economy may be expanding. So diesel, I like calling it the heartbeat of the economy because trucks and agriculture are at the center of it. Think about it. When people are buying more stuff, there's more demand. And that means more Amazon trucks, more Walmart trucks, whatever trucks, FedEx, UPS, ships, that goes into marine bunker fuel. So diesel markets definitely matter because inventories could tighten, freight costs could rise, manufacturing and agriculture costs rise, and inflation rises. So that's what happens when diesel is headed up. So financial traders often watch charts. They look at technical indicators such as moving averages, RSI, MACD, volume, support and resistance. We actually quantifiably go through this for natural gas and crude oil every single day. We look at all the MACD, RSI, simple moving averages, stochastics, Bollinger Band, and we come up with a 1 day view, a 1 week, 1 month, 3 months, 6 months. So financial traders watch all of this every single day because there is some credence to with 2.4 times the physical market trading the market. A lot of them are making their decision on technicals. So
Right.
fundamental traders will watch data like production, refining runs, imports, exports, storage, demand, weather, inventories, petrochemical demand, inventories, refinery utilization, distillate demand. That's why we put all of this together into one page so that you can understand the market in a very quick, condensed. You can spend 30 hours a week. You have three choices if you want to understand energy markets. Spend 30 plus hours a week, spend tens of thousands of dollars, or ignore it. The better option, subscribe to Energy Road. So there is a
That's
link
right.
down below.
For cheaper than your Starbucks coffee every day, you can understand the energy market. So whether you are a producer, end user, a trader, or if you're just energy curious, you guys
Yes,
need to subscribe to Energy Rogue.
yes, definitely. So technicals versus fundamentals. Technicals are the charts. That's the moving averages. That's the oscillators. That's the stochastics, the relative strength index. The technicals answer what traders are doing. It reads the psychology of the market, the positioning, the momentum, the fear, the greed, all of that. The fundamentals answer what the actual fundamentals are doing, what the demand side is doing, what the producing side is doing. And that reads the physical world, physical supply and demand. Both matter in different ways. Technical matters and fundamentals matter, but they matter differently. And the skill is knowing which one to wait and when and why. So those are the key. So often technicals or a financial market are short term, days to weeks. That gives you the psychology, the positioning, the momentum. Fundamentals are going to be weeks to months. That's going to be your supply side, your demand side, storage, flows, infrastructure. And sometimes fundamentals will give you the long cycle viewpoint to give you ideas of when there's big cycles starting or ending. And that's what we watch every single day here at Energy Rogue.
Right.
So, which one is better for forecasting? Now, I would say both, but maybe in a relatively different lens. Short term, I'd put 80% on the financial side, 20% on the fundamental side. And medium term, I'm going to put 50-50. And for long term, I am looking at 20-80. That's my
Well, that's just because you
breakdowns.
like things to be, that's how you just like things to be in balanced. I'll agree with you on the short term. It's 80-20. On the
All right.
medium term, I'm going to go which ones were you going first? Is it technical first or the
Yeah,
fundamentals
the
first?
financial side first and then the physical side second.
Okay. Then I'm going to say in the medium term, I think it's 40-60 at best. And then long term, I think it's 10-90.
Okay. I'd buy that. Um,
So
but the key is on that both of them matter. You can't ignore the other because the other
right.
could determine when it does that. Now, why do financial markets and especially in commodities overshoot? Well, fear, greed, fundamentals, and I would call it fickleness and a small crowd. The energy, even though there is a lot of money traded,
You've gone to creating words now, haven't you? You just making up words.
fickleness,
Fickleness.
fickleness is a word.
I don't.
Fickleness.
Yeah, maybe.
Fickleness definition right there. Tendency to change in one's opinion. See?
Oh yeah, yeah,
Fickleness.
yeah, yeah. Where did that come from? Where did that come from?
Webster.
Webster.
We'll call it
He's
Webster.
too. He's too old. I bet it. I bet it's Wikipedia. There you go.
All right. Well, but markets often overshoot, and especially in the energy markets, because there's a smaller select group of who trades energy, and it's mainly
Right.
because of the volatility and the financial commitment that is involved in
Yes.
energy commodities.
Takes a lot
And
of credit.
because of that, you can think about it this way: the S&P 500 may have millions of traders around the world, whereas the energy commodities maybe 200,000 to 500,000 participants.
Yeah.
And those are guesses, but I'm trying to directionally say it's a fraction of what the equity markets do. So,
Right.
but the market is a story. Financials tell you something. Physical markets tell you something. The financial markets tell you what the traders believe. Physical markets tell you what is actually happening. They're both telling you a story, but they give you different things. Now, the rogue method, what we often look at is we go through visibility. We observe what is happening in the technical side. We observe what is happening in the fundamental side. And then we validate and check. That's what this process is. Every day we're checking what's happening on the technicals, what's happening on the financials, what's happening on production, demand. And then we go through a validation of what that is. And then we figure out the velocity. If production went up, well, how much? Let's take an example. If production went up, okay, this was flat to last week, but versus last year, it's up 0.5%. Versus 3-year average, it's up 4%. But when we flip to the total demand side, we're up 13%. Okay. So that tells you kind of a velocity of what that means in what time period it is. So what do you do now? What most participants do, they study the price. They only look at the financial technicals. What professional dues, now that I made up.
Dues. Is
That's a
that
word I
dues like
made up.
D? Is that dues like DOES, which should be say does, or is that dues like DUES? It's what they have to pay.
Oh my gosh.
Could be
I don't want
both.
to, it could be both. Um, Most participants only look at the financial piece. What professionals do is they look at the physical side, they look at the fundamental side, and the financial side, and they understand what is resulting in that matrix and which one is driving the bus. And
That's right.
how many they figure out, for example, how many barrels actually exist? Can supply meet demand? Can molecules really exist that way? And I'll give you an example. Prior to the US Iran war, there was 105 million barrels a day of supply and demand. That was both supply and demand, roughly, depending on that. Strait of Hormuz gets shut in. There's roughly 15 million barrels a day that goes offline. So your supply goes down to 90, right? What happened to the demand side? Well, the demand went down to 100. We lost 5 on the demand side of the equation. All right. So now the question is, what's making up this 10? Well, we're drawing it from stocks and storage, all the storage from around the
Right.
world. So the question on the table is, what happens if the Strait of the Hormuz opens up? How much of the 15 is coming back? How much of that 5 is gone forever? How much of that 5 is coming back? These are the questions that we dive into every single day. There's information down below how you can subscribe, because some people come to us, they just want to hear our newsletter and what we're thinking on the market, what we're observing. As we normally talk, you will recognize differences between what Bill thinks and what I think, And that confuses some people. To us, it's a better sense of truth. That gives us a better sense of what reality is, because I don't want people to agree with me. I want to test out a thesis, an
Right.
idea. And that's what you should do every day. But don't do this blindly. If you're focusing on the energy markets, if you're doing it blindly, you are going to fail. So,
So to bring it all together, when you hear the term the market is the consensus of all this activity that's taking place below.
right.
And when someone says the market, they're talking about all this tied together. So that's why it's very important to know which piece of this today is actually having the most influence on the pricing. And so my other thing that I go by, and I look at, if prices go up, good, prices go down, bad. I know as a consumer, that's not good, but that's where I look at it. I
Mhm.
find that things can go bad faster than they can go good.
Right.
So production can come off faster than it can come on. And
Yep.
so those are the things that you have to look at. And really most of the stuff is probability and some finance and some physical. It's a combination of all of that. And all of that combined, put together, is the market.
Yep.
As opposed to a highway will never be a thing. I'm sorry. I'm just
The
California, you're
highway.
wrong on that one. You're just wrong
The
on that, California.
Well, and if you go US and British, you will find out that we say the hospital. British says hospital. So in the US, we say we go to the hospital. And in Britain, we go to a hospital. There is no the. So it's kind of interesting. Words is good.
Words is good.
Words is good. Well, listen, folks, thanks so much. If you're serious about energy markets, there's a free ebook down below that tells you how to understand the market in 5 minutes a day. And also, if you or your business is exposed to energy markets, whether it be natural gas, whether it be crude oil, whether it be refined products, natural gas liquids, you need to get armed with information, and the information about the physical market and the financial market. We have a service, Rogue Radar, that accomplishes that, and it is a very small investment of $89 a month, and we'd love to see inside.
That's right.
So
So come on,
listen,
go rogue with us.
go rogue with us. So listen, folks, thanks so much. Thanks for hanging out with us. Hope this helped. Let us know in the comments how we're doing, and we will talk to you. When are we going to talk to him, Bill?
We're going to talk to him next week. Once again, we'll be here next week.
All right, folks, we'll see you soon.